United States is the leading economy in the world. The United States is the strongest economy in the world, but some people are naturally worried that another company is going to come around and their economy is going to grow bigger than the United States. Or they're also thinking that smaller countries around the world are growing faster than the United States right now, which makes sense because smaller companies grow faster than bigger companies. When you're this large, big behemoth of a company, it's much harder for you to invest in innovation and grow much bigger because you're already very large. But if you're a small company, well, now you have the ability to grow way bigger faster because you're small, and so you have a lot of opportunity to grow. It's the same with this here. When you're investing in emerging markets, the whole idea is you're taking on a little bit more risk because you're investing in new countries, things like China and India and Brazil. And what you're hoping for here is that these smaller countries are going to see economies that are going to grow faster because they're smaller and they have the opportunity to grow bigger. Plus, you naturally have some people that are a little bit worried about the long-term health of the United States economy. So they want to diversify some of their money outside of just the United States economy. And one way that you can do that is by investing your money into emerging market ETFs, because this gives you exposure to the economies of different countries around the world. Again, a couple examples of this would be VMO and IEMG. These are two different ETFs that give you exposure to emerging markets. Now again, this is where you want to do a little bit of your own research and see which countries each ETF is investing in and see what you'd rather have. Do you want more of an exposure to China, or do you want more exposure to South Korea? And so you just gotta figure out what's important to you, because this ETF is going to give you more exposure to China. This ETF is going to give you exposure to a broader range of countries. But now we're just getting into the details, because in either case, you're going to be getting exposure to emerging markets and emerging countries around the world to give you some diversity outside of just the United States itself. The fifth type of ETFs that you may want to consider investing in are innovation ETFs. We are in the innovation age right now, where technology is growing and innovating way faster than we've ever seen happen before. I mean, for all the 80s and 90s babies out there, you probably remember that when you were a kid, the internet wasn't what it was today. When you had to go on the internet back when you were a kid, you had to make sure that your mom or your dad wasn't on the phone because you had to go through dial-up, and anytime you went on the internet, it was like, you remember that whole sound bite that you had to go through to get on the internet? Well, now look at how far we've come with innovation. And so if you want to invest your money into the future of innovation, then you can look at innovation ETFs. So some of the most popular innovation ETFs are managed through the ARK fund, which is managed by somebody named Cathie Wood. And Cathie Wood is now a famous investor because of the returns that she's gotten her investors. And just a disclaimer, I do have my own money invested in a handful of different ARK funds. But the whole idea behind these ARK funds, their symbols are all ARK, A-R-K, and then something. Like ARK-K is their flagship innovation fund. If you put in a G here, it's the Genome Fund. If you put in an F here, it's the FinTech Fund. They have a fund for space exploration. They have a fund for a lot of different things in the innovation space. You can just go onto the website and see the different funds that they are. But again, the whole idea here is you are trying to get some exposure into the innovation side of the world. Another thing that you want to understand about these is that these funds also come with their own fair share of risk, because you're investing in a lot of smaller companies and a lot of startup companies. And these funds are also more on the actively managed side, which means that you have people actively working to try to find the best companies to invest in. And so your expense ratio, remember we talked about that a little bit earlier in this video, is going to be a little bit higher here, because now you're actively paying somebody to help manage this fund. But if you're one of those people that wants to be invested into the innovation side of things, into the newer companies, into the newer technology, and you want to hope that one of these smaller companies takes off, well, then some of these ETFs might be right for you. The sixth place where you may want to consider investing your money in ETFs are REIT ETFs. I didn't write the word ETF. REIT ETFs. And what a REIT is a real estate investment trust. So for all of my real estate people that want to get exposure to real estate on the stock market, this can be a way for you to get exposure to that by investing your money in REITs. When you invest your money into a REIT, you're investing your money into a company that invests in real estate or that invests into mortgages. So you're not getting direct exposure to the real estate per se, but you're investing in the company that invests in real estate. So the whole idea is if real estate goes up, or if real estate is really booming, well, now this company is going to be booming because it's investing in real estate and you're investing in that company. So it's not a direct investment in real estate, it's an investment in the company that invests in real estate. A couple examples of REIT ETFs would be VNQ and IYR. Now, the thing that makes REITs interesting is REITs are required by law to follow something called the 90% rule, which says that REITs are required to pay out 90% of their taxable income or their profits to their shareholders, people like you, through dividends. And so a REIT's income comes through rental income, because these REITs own these rental properties, these investment properties, and they make money from rent. And then after they pay all their expenses, their management fees, their property insurance, their utility bills, their property taxes, their other fees, once they pay all their fees, then they take the rest of this income and 90% has to be paid out to people like you, shareholders, through dividends. An ETF's job, again, is to minimize the risk for you. So now instead of you trying to find the best REIT to invest in, now you can invest in a REIT ETF. That way we get exposure to a whole bunch of different REITs that we don't have to worry about trying to find the perfect REIT to invest in, because REITs do have a lot of volatility, especially the ones with the higher dividend yields. And this brings me to the 7th type of ETF that you might want to consider investing in, which are your growth stock ETFs. These are your companies that are trying to grow as big as possible, as fast as possible. And then within these growth stocks, you have your large growth stocks and your smaller growth stocks. Your larger growth stocks are a little bit more mature. These are your companies that might be making profits, that might be paying out small dividends, but they're still really investing in their growth. They're still investing a lot in innovation because they still want to grow bigger. So the first example of this could be investing in something like QQQ. So QQQ gives you exposure to the NASDAQ, which is essentially the 100 largest companies which are not financial. So these would be companies like Amazon and Apple and Microsoft and Tesla. A lot of these companies are tech companies, but when you're investing in QQQ, you're getting exposure to 100 of the largest non-financial companies, which many of them are in the tech space. On the other hand, you also have the small cap growth stocks where you can get exposure through something like SYLG. So SYLG invests into the smaller cap growth companies, and these are going to be a lot of companies that you might not have heard of. A couple popular ones are things like Crocs and maybe MicroStrategies, but the goal with both of these ETFs are to give you exposure to these growth type of companies. One gives you exposure to the larger cap ones. These are going to be more of the companies that you've already heard of. This one gives you exposure to the smaller cap companies, the smaller companies that are really fighting to become much bigger. Remember, more risk comes with more potential return, but you also have more chances to lose your money. This again goes back to your goal. What do you want? More risk comes with more potential return, but it also comes with more risk. Less risk compared to this comes with less potential return, but also less risk. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.